You are listening to the Manument Podcast. My name is Casey, and I'm here with my buddy Glenn Johnson, investment advisor and founder of Jabez Financial right here in the Uncasville area. I want to start with this list that I found this week of the strangest and most unusual taxes that have existed throughout history. I found this article, and I knew it would be fun to get your thoughts on it. So some of these taxes throughout history include a beard tax in Russia. Emperor Peter the Great taxed beards in 1705 to kind of help modernize Russia. They had a window tax in England. This was introduced in 1696, and this was aimed at wealthy people who had a lot of windows on their home. And then my favorite of the whole list, the cow gas tax in the EU. Some European Union countries taxed cattle owners due to methane emissions. So I was reading through these and thinking that these weird taxes, Glenn, probably caught a lot of people off guard. And I feel like the same thing happens today in retirement. So I wanted to ask you about some of the unexpected taxes that can kind of blindside retirees and how you can help people plan around these, Glenn.
Well, you know, it's interesting. We have to look at taxes with a little different perspective. See, the government uses taxes as a tool to direct the way they want society to live. They use them as a penalty. For example, the government will tax you on things they don't want you to do, and they'll give you tax breaks on things they want you to do. For example, they'll add additional taxes to things like gasoline and cigarettes and alcohol and luxury cars or jets, because they want to steer people away from those, so they'll tax them more. But then, in the same respect, they'll give you tax breaks on things that they want you to put your money into. So whether you're investing in solar or wind power, or if you want to lend money to a municipality, if you want to have children, or even start a business, there'll be tax breaks and advantages if you're making decisions that are aligned with what the government wants you to do. And just like all those other taxes you were just listing, it's the government that's taxing to direct people to live the way they want to live. It's kind of interesting, you know, and the funny thing is, you know, that old saying of George Washington, you know, he never told a lie. Well, he also never had to fill out a tax return.
That's a great point, Glenn.
You know, so that's what's so frustrating for people with taxes. It's not that people don't want to contribute to the betterment of society and the quality of life, whether it be for parks or schools and have the roads paved and things like that. But it rubs people the wrong way when they're taxed so that it changes the way they want to live their lives. And that gets frustrating. That's where one of the most significant times in life where the government really steps in is when later in life, you think you're done. You've worked, you've saved, you're retired, and now you're done. Okay, you've paid your dues. But now you're going into retirement, and now you're 73, or it'll be 75 for some people, where the government steps in and says, oh, guess what? I've been a silent partner in your retirement plan. All that money that you've been setting aside, tax deferred or pre-tax, now it's my turn to step in and get my cut. And the government forces people, whether they need to, want to, or not, they force people to start taking money out of their retirement accounts, out of their pre-tax accounts, so that the government can now get their cut of your retirement through required minimum distributions.
Yes, I'm so glad you brought up RMDs. Once you hit that age, 73, you cannot defer the taxes on your retirement accounts any longer. You've got to start withdrawing, even if you don't really need it. And they can easily turn into a nightmare if you don't have a plan or a strategy set in place, because you or your family down the road can really find yourself inside of a massive tax trap when it comes to these RMDs, right, Glenn?
It's true, because and what happens also is, let's say somebody ends up taking out more from their required minimum distributions than they need to or want to. That's the first step where their taxes increase. And then, should one spouse pass away, now the tax bracket jumps up for the surviving spouse, because now they have to file a tax return filing single. So their tax bracket goes up. So now the government gets even more money out of that retirement account. And when we think that's bad, when the surviving spouse passes away and those assets go on to the kids, it used to be the kids could just keep the money for themselves and use it for their own retirement. But now when the kids inherit the money, they have to take all of it out within 10 years or less. And if there's a significant amount of money in that retirement account, that jumps up the kids' income tax bracket, and the government gets even more.
Well, I'm glad you mentioned the 10-year rule for inheriting an IRA, and I'm wondering, Glenn, what strategies families can implement now to reduce that future tax burden? How do we plan in advance for this? Are we talking Roth conversions? Are we talking a trust? Or are we talking something else that I might not be thinking of?
Well, Roth conversions is definitely the place to start. So what I like to do is from the day somebody retires to when their required minimum distributions begin, that's the time to be maxing out their tax bracket with as much Roth conversions as possible. I mean, and it's never enjoyable to be the bearer of bad news by saying, hey, you know what, you've got to take more money out of your pre-tax account, experience the tax burden now. But if you look at the overall tax burden, it's proper tax planning. So from the time you retire to when the required minimum distributions start, we want to make sure that you've done as much of a Roth conversion as necessary so that your required minimum distributions don't exceed the amount that you want to be taking out anyway. That way the RMDs really don't affect you that much because you'd be taking the money out anyway. So let's convert as much as we can between when you retire and age 73. And then afterward, we still may want to do some additional Roth conversions so that when the assets get passed on to the next generation and they have to take them out over 10 years, it doesn't affect the children's tax consequences.
I think it's super important to be aware of these strategies, and then also super helpful to see how they can actually play out in real life, because I think a lot of our listeners probably, Glenn, learn best through real world examples. So I'm wondering if you can give us an example of somebody who didn't properly plan for these tax rules and how it impacted them, and then maybe walk us through what it looked like once you stepped in and helped them put a strategy in place.
Well, it's surprisingly common, and that's why when I sit down with clients, I start with segregating their money between pre-tax, Roth money, and after-tax. And it's interesting to see how significantly different people's assets are when they walk into retirement. For those that have been using a financial advisor or been doing proper tax planning throughout the years, they've got a good balance between pre-tax, Roth, and after-tax money. But for those that weren't properly planning along the way, and say they were just using TurboTax, for example, filing their own taxes, when people are doing that, they're just looking at that particular tax year. They're not doing any tax planning. So ultimately, when they go to retire, a significant percentage of their assets are in pre-tax accounts. They're all in traditional IRAs and 401ks or 403bs. And very little Roth money or after-tax money. And that's what gets people put behind the 8 ball walking into retirement. I find that often where somebody has the overwhelming majority of their money in pre-tax accounts, then once they retire and it comes time for them to buy a car, now they're concerned about taking an extra $30,000 out to pay cash for a car, and they end up getting a loan to do it because it's not that they don't have the money, it's just that they don't want the tax burden. Or they'll be concerned about taking the money out in September when they want to buy a car, and they'll say, well, I guess we'll have to wait until January to do it so that we can pull this money out in the next tax year. Casey, the idea is to have your assets not just positioned in the right allocation, but also positioned in the right types of accounts so that the tax year doesn't determine when you pull money out to buy a car, take a vacation, remodel the house. We don't want the stock market or the government involved in the decisions that we want to make the way we want to live our lives. So if you could give us a call at 860-288-9977, I'd love to have the opportunity to sit down and put a strategy together with you so that when you're living in retirement, you never have to check with the government or the calendar to determine whether or not you can go get a new car when it's time for you to have one.
860-288-9977 is what you need to dial if you have questions about getting a plan set in place for you and your loved ones down the road. This is your sign. Don't put it off any longer. And it all starts with that initial conversation with just you and Glenn. You can talk on the phone. You can meet in his office, whatever you're comfortable with, but you can explain to him what questions you have. And then he can share with you some information about how he and the Jabez Financial team might be able to help. So let's put a time on the calendar today, 860-288-9977. You can also head to jabezfinancial.com and click on the contact tab, and we can get connected that way as well. 860-288-9977 or jabezfinancial.com. Thank you so much for listening to this episode of the Manument Podcast. Make sure you subscribe wherever you get your favorite podcasts so that you never miss an episode, and we will see you next time. Take care.
Investment advisory services offered through Jabez Financial, LLC, a registered investment advisor firm. Registration is not an endorsement by securities regulators. By contacting us, you may be provided with information about insurance products, including annuities, offered through Glenn Johnson, Connecticut Insurance, license number 4628409. The firms are separate entities. Annuity guarantees rely on the financial strength and claims-paying ability of the issuing insurance company and are not offered by Jabez Financial, LLC. Read your contract for restrictions, limitations, or penalties. Jabez Financial, LLC is not licensed in all 50 states. To find out if Jabez Financial, LLC is licensed in your state, please call 860-390-0093.